Good evening, ladies and gentlemen. This is Clueless A Trading Frank. It's approximately 8:13 p.m. Eastern Standard Time on February 16th. I'm sorry, February 6th, 2018. Full disclosure, this is purely for financial education, not for any solicitation or advice. This free webinar, strategic webinar session will be uploaded on the Clueless A Trading YouTube channel for free viewing. Highly suggest that you refer friends and any other traders that you know to listen to the free YouTube channel, as well, more importantly, to sign up as a member on Clueless A Trading. Our motto is tactical, not emotional trading, and you guys know that by now. Let me make sure that we have a quick roll call to make sure everyone's here. We have Amin. Do you have audio and visual? Can you hear the voice? Can you see the screens? Amin? If you don't have a mic, just type in yes on the dialog box on GoToMeeting. Okay, Axida, you have audio visual?
I do, yes.
Excellent.
Good evening.
Thank you, Axida. Mike is good. He confirmed earlier. We have Trent, and we probably have a few other people from the West Coast who are going to be signing in shortly. All right, so let's kick off. I'm going to make this short and sweet, and I don't want to go in for a 2-hour session. Just keep it within 60 minutes max. All right. First of all, a couple of broad points here. This is an extremely, extremely difficult market. It was difficult on the way up, and it is very difficult on these absolutely wacky, out of control flash crashes, overnight futures down 100. I mean, unheard of things. These are known as black swan events. You don't know what a black swan is? Then I highly suggest that you Google the term black swan. It's a term that was coined by a gentleman from Goldman Sachs back in the 80s, I guess. His name is Nassim Taleb. So read up on the black swan. It's a rare, rare event. It's like a blue moon type of thing. And when they happen, it throws everything out of whack. And that's exactly what the market is right now, completely out of whack. Doesn't matter that we rebounded today, it is still completely out of whack. And when these type of things happen, and they happen very suddenly, it is very, very difficult to react to them. Now, the juvenile trader who's never really made any real money in the market, hasn't made money in the market on the upside, for sure, will say, hey, I saw that coming. That's all garbage. In hindsight, everything is 2020. So, they automatically assume that, oh, they knew exactly what was going to happen. Sure, we all know exactly what's going to happen. It's going to rain 2 days from now. It's not that easy. So the point that I'm trying to make here is we are dealing with a market which is completely robotic. A market which, even with all the finest technical analysis, the finest tactical charts that are produced and delivered to all of you on a real-time basis every single day, it is still very difficult. Now, saying all that, there are certain things which are on a technical basis which can be traded on, what we call tradable bottoms. That's something that I mentioned on my last webinar. I have put through on my daily comments as I show the charts, and those are extreme, in simple terms, extreme oversold conditions. Now, for some of you who are not technically savvy or refuse to really understand technical analysis, you might think, yeah, so what? It's extremely oversold, so what? Well, it's not the so what. I said the markets were going to have a powerful reflex bounce. We had a 1,000 point powerful reflex bounce. I mean that. Now somebody will say, what do you mean 1,000 points? Well, we're up a 567 Dow points today, and overnight we were down about 500 plus points on the futures, on the Dow, if not more. We lost more, or close to 2,000 plus points in 3 days on the Dow Jones. It causes massive fear. It brings out the most dogmatic of the bears, not the tactical bears. We're tactical bears too at times. I did suggest the SPX 2735 puts yesterday, which went from $4 to $90. And if you guys care to look, the chart, the options chart has been published on my Twitter feed. Now, did I ride it all the way from 4 to 90? Absolutely not. Did I ride it a good way up? Yes, I did. And I had one call left that went into not the $90 range, but up there. I mean, one put left. Because I had a bunch of them when we bought them at 4. Now, do the simple math, which I did for you guys on the Twitter feed. From 4 to 90 is close to 2,200%. So if you put $400 in, you would have $9,000. If you put $4,000 in, you would have $90,000. So I did my job, whatever was needed to. How you guys handle that trade, that's your problem, not mine. Okay? Just stating facts here. So at times, we are tactical bears. But at times when I have shown where, and I'm going to show some of the charts, where we have massive declines, and the McClellan oscillator is at minus 400. And these charts have all been posted if you care to look. So I'm not going to repeat the whole overall thing. And for example, on the NDX, on the NASDAQ, the McClellan oscillator on the daily is at, and it started to turn today obviously, is at minus 360, approaching 400. You gotta respect it. We're gonna have one heck of a reflex bounce. We ain't going back to the highs. Maybe we will in a few months. Or maybe we will in a few weeks. I have no clue. But I'm not talking about tomorrow or the day after. But I do know, as I've stated repeatedly, that between 24 to 48 hours of these type of readings, you are going to get one vicious bounce. Case in point, today. Now, all these things that I preach to you guys for $60, for $70 a month and $90 a month for platinum members, you need to pay hundreds of dollars to some other service to explain to you. Or you listen to Mr. Kramer, who's a very smart guy, Jim Cramer, on CNBC, and he's explaining the McClellan oscillator in very simple terms, not to the degree that I do. And this is not the first time I've explained that. And I just caught him for like 10 minutes, earlier on, because my work TV is always on Bloomberg or on CNBC. And I'm listening to him explain how he pays a lot for his S&P oscillators, and when they show minus 6.5 or minus 6.7, and that I've showed to you guys, which I'll show again on my SPX 533 charts, he goes, my finest technicians say you got to buy. Well, he's right. So you're getting all this stuff well ahead of it, not after the fact. Because I told you guys all that 2 days ago, that this was going to happen. Will it be a continuation pattern? We shall see. It certainly looks like one, based on the charts that I follow, and based on the charts that have been right almost 100% of the time of extreme lows or pullbacks of extreme highs. So I highly suggest that you all start getting a little bit focused and try to make back what you could be down on. Let's face facts here. We've all lost money over the last couple of days. Not today. Regardless of hedges or whatever, there have been losses. Because on a overall basis, we were long. And the market basically went berserk on Friday, pulled up on Monday, and then did that 3 o'clock downturn, which I've explained clearly on my past videocast. So when you get that type of calamitous drop, like we saw yesterday at 3:15 p.m., when huge margin calls were generated. And I'll explain to you one single factor which caused it. Then there's nothing one can do. What one can do is they can buy the tactical lows, as I alerted today, and make back a substantial amount on multiple selected trades, whether it be Apple, whether it be Google, whether it be Amazon, whether it be Netflix, whether it be Nvidia, which was just huge, up 7%, and from bottom to high, much higher than that, whether it be Goldman Sachs, whether it be the SPX, the SPY, the RUT, or the IWM, or Boeing, which was up 4%, $13, and multiple reversals, whether it be Twitter, so name it. That's some sort of ad coming in from Google. So the bottom line is that people who acted on it, they came out okay, or probably had a great day. People who didn't, well, it's the same old story. I can't do anything about it. So, saying all that, it's a very difficult market. And we have to be extremely focused on what is going on, because there is stuff flying from left field, whether it be some stupid comments coming out of Washington, D.C. for once in a long time. And if you read my real-time posts, I put out a couple of pieces, and some of them I call dumb tweets. In the middle of a 2,000-point market drop, we get some dumb tweets coming out of POTUS from good old Donald, who I respect very much, a supporter of, primarily of his massive business-friendly policies, coming out with some dumb, well, I'm not going to say the second word, tweets on whether the Democrats clapped or not. The Dems and the liberals don't have to clap when he's on the State of the Union speech. That's just the way democracy works. And I read that thing. I'm like, what kind of stupidity is this? He should be putting out a tweet out there saying the markets are fine. They are up a gazillion points since I got elected, which is a fact. And now they're pulling back a little bit. Relax. But then the White House came out and made some assuring comments. And Steve Mnuchin, who's our Treasury Secretary, made some powerful comments. And that was well received. Because I'm a straight up guy. We don't eulogize humans. We eulogize and pray to God. Okay? So when a human is being stupid in their actions, I'm going to say it the way I see it. And nobody could come and accuse me of being some, couch liberal who sits around and does nothing and wants everything from the government. Hey, you guys know I'm not like that. So there's a bunch of things going on here, which are, one is the political stuff, because we have a budget deadline coming through. We have a spending bill deadline coming through and a government shutdown in a couple of days. We need to get this stuff through, whatever it takes. We can't be sitting there pissing on the other side. We need to get stuff done. We need concrete actions. So here are the risks in the market. As you're looking at this very technical chart of the S&P 500 E-mini futures behind you, which has been drawn to perfection and played to perfection today. Not just today, many days, but this is for today, after the crash. Is that we have a political risk coming out of Washington, D.C. They got to get stuff done. I don't care what it takes. Okay? Number two, we have earnings which are coming out very well. 80% of S&P earnings have been estimates. Even Snap up 22%, 23% after hours. I mean, Snap of all things, getting their act together, which is going to be very helpful to Twitter, which is already doing very well. We have the panic situation going on, and the primary reason why the markets were down big time, which I put out on my Twitter feed. The real technical reasons why we had the flash crash and the subsequent global fallout overnight, where futures were at one point, I think, were down 40. And I posted that because I woke up in the middle of the night, like at 3 o'clock. I'm like, oh, Lord, here we go. Not good. And can somebody step up and tell me what that was? I know Trent probably knows the answer. Trent, what was it? No. I'm asking the reason for the big flash crash. Not asking for the Japanese bank interventions. Central banks will always intervene to save markets. And that's completely A-okay with me. Because I don't want people's 401ks from here to Oklahoma blown out because central banks are sitting aside. That's not the point. Not the VIX.
It was the XIV and the SPXY that crushed.
Thank you very much. Thank you very much, my good friend Golf. Okay? So basically the volatility shorts, as Trent mentions, XIV, and I put out that chart out there, okay, was the main culprit. And honestly, I didn't even know about it till I started looking into it. Like, that was unheard of. Look, I've gone through enough crashes, okay? My first flash crash was back in 2010, in May, I believe. The market dropped 1,100 points, and at that time, the Dow was way down. So on a percentage basis, 1,100 points was like, whoa! Now, 1,100 points on a percentage basis, look, what, like 2%? So on a percentage basis, really not a lot. Imagine we get a 10% correction, which we already had overall, I believe. But imagine what do you call I think we had a 10% correction in the S&P 500. But imagine a 10% correction from where we are right now, which is close to 25,000. You're talking about another 2,500 points. So that flash crash, I remember, was a one-day event. It was during the Greek, not Greek. What was that? Yeah, I think it was the Greek crisis at that time, and things just boom went nuts. So anyway, so when I saw that, I'm like, makes total sense. I don't play on the XIV, so I don't know about it. All we do is we take hedges on the VIX. And because the markets were so fast and rapid, they didn't even get a chance to buy the VIX calls. That was one thing that pissed me off myself. I get angry at myself too, a lot. And I hope some of you do get angry at yourselves too. And I really was pissed off at myself that I didn't see the VIX thing coming. But anyway, can't change what I didn't do. I can only change what I can do going forward. I'm doing the right thing. So this XIV, which is the short VIX ETF, right? So if anyone wants to, short the VIX, now why in the world would somebody want to short the VIX when it's at 9 or 10? I mean, it doesn't make any sense to me. But hey, people do that, I guess. But it's not people. It's a lot of hedge funds betting that the VIX should keep on falling. That is so stupid. Just shows that smart money can be extremely stupid. And remember one thing I told you guys. That when they buy $1 of something, the hedge funds, they can borrow up to 6 to 10 times that. So $1 that they put in, they can borrow $6 up to $10. So their leverage ratio is, in this particular case, they're borrowing 5 or they're borrowing 9. That's a lot of money. You are highly leveraged. Us, on margin accounts, we can only borrow 50%. So if you buy something at 10, then you have to put up $5. This is a very simple concept. This is what happened in the markets. So these bozos are leveraged 6 or 10 times more. So when this thing collapsed, it went from 146. It was halted. It opened up at $6 or $5.78, and it closed today at, what did it close at? Like $7.40 or something? No, at $6.12. Let's call it 6. So the freaking thing goes from 146 to 6. They are blown sky high. That is a mushroom cloud. If I can draw a mushroom. Is that a mushroom? I'm not sure. Okay. Of an atomic explosion. No wonder the markets, our markets, went nuts. Because every asset class, I don't care what it is interconnected. And these hedge funds who were heavily placed on the XIV, which is the VIX, shorting the VIX, and then the VIX went nuts, right? The VIX went nuts. The VIX didn't just go nuts on its own because these guys fell that hard, so the VIX technically was pushed up big time, as you all know. And I put that through because on a real-time basis at Clueless A Trading, we like to keep our members and traders educated. So the VIX basically went from 13 or 12 on the 29th, and from the 5th, which was 2 days ago, it was at 17. It went to frigging 30. It went to 53. Now, you guys do have a right to slap me for saying, why don't we go into the VIX calls? I will admit that was a big, big error on my part. And I do apologize for that. Because generally, we do have VIX as insurance. But it was happening too rapidly, and I just couldn't quite get around to it. So for once, well, not for once, I've said it before, I'm sorry. I'm a real guy. I'm sorry because I didn't make tons of money, and then I didn't lead my flock into doing that. So bottom line is the VIX goes from 17 2 days ago or yesterday to 53. That's like a $17 stock going to 53, and this baby goes from 146 down to 6. Hallelujah. These are directly correlated. This is the short VIX, so it collapses and the VIX explodes. It pushes the underlying assets way higher. This was the main reason why we had the flash crash. I said it before. There were no economic reasons. Bond yields were down. The Treasury bond deal, which initially caused the market pullback, or minor pullback, I should say, overall, which I said before was going to be 200 to 400 points, not 2,000 points, was contained. The TNX, or the 10-year government bond yield, as I showed on my chart, started to ease back from 2.85% down to 2.5% today. But this little time bomb just rocketed the markets down because the notional value, I think there's $80 billion in this thing or something I heard. But the notional value, that means the leveraged value, is more like 200 billion. Okay? It's 80 billion or less in this thing. That's how much they borrowed. So they got blown out. And that's like a pipe bomb going off in the middle of a crowded street. That's what happened. Okay, so I don't want to get into it too much. So at least you guys know by now. Okay, let me move this out. And that was the sole reason of what happened in the market. And this caused the global fallout. They're talking about inflation going rocket high. Well, I've already explained my views on inflation, and I'm right or wrong. I think I'm going to be right. There's no massive inflationary pressure. There's some wage increases. Listen to my past videocast for that rant of mine. A Walmart worker ain't becoming a millionaire because his wages went up by $5. Does it have upward pressure or inflation? Sure. Does it mean the Fed is going to go hog wild and raise rates? Nope. Jerome Powell, nominated by President Donald Trump, is a very fine gentleman. He's cut from the same cloth as Janet Yellen. They are here to do what it takes to make sure the U.S. economy is humming along. She's not going to go nuts and raise rates. So all these bears come out, hardcore bears come out, and they tell us that that rates are going to rise 6 times this year, blah, 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 blah. And after this type of crash, now the Fed funds futures are predicting that we probably have, if we do, 3 rate hikes this year. Great, great, great. It's great news for the markets. You don't need 6 rate hikes. You need maybe 3, maybe 4. And I'm not a central banker. I'm just giving you from my experience of what I've seen in the markets. All right. So that's the main reason of what happened. But that caused havoc. Havoc! Stuff like, when we had the flash crash, stuff went down by 30, 40 points in a second. Because when the XIV blew up, they were trading platforms which were shut down. Some of these garbage trading platforms like Robinhood and God knows what that they have out there, Betterment, these guys couldn't even handle the orders, so they shut down. Because I believe a lot of millennials and stuff were heavily invested, or at least had a lot of money, hedge funds included, in XIV. I don't know what the heck they were thinking. It must have been that $20 glass of bourbon that they drink. Seriously. Stupidity at its finest. So bottom line is that they got what they deserved, I guess. So now let's talk about markets. Now the markets have stabilized somewhat. Futures are down about 4 points right now. And I personally don't trust anything. Because in the middle of the night, I'm going to be checking things. And I wouldn't be surprised. And this is what I want you guys to be aware of. I wouldn't be surprised if futures are down 50 for whatever reason. It's a really dangerous market because of no other reason other than, and somebody fill in the blanks what I'm going to say, other than not just XIV and stuff, but what is making the markets move like in nanospeed, in hyperspeed during the day and during the night. What is causing that?
Margin calls.
No, margin calls are, if you're correct, but that's a consequence of that. Trent answered the questions. High frequency trading, algorithmic high frequency trading. Okay, the machines are on. They're just nuts. Just the way they're nuts when earnings come out. Now they're nuts during the day, at night. And Trent, correct answer. Your answer is correct too, Golfy. But that's a consequence of it. Of course, there are massive margin calls. When you get $200 billion worth of notional value getting blown up, you are going to have margin calls. That's what keeping up the pressure on the stocks. But real buyers, who are the mutual funds and the pension funds and people like that, are stepping in. They're saying, crap. I'm seeing a great company like NVIDIA down 30 points in 5 minutes. I'm going to buy. I'm seeing Apple down like, Apple got hit hard and up. You know, I'm going to buy that. I'm going to see Priceline down 60 points. I'm going to buy it. I'm going to see a company like Goldman Sachs down 13 points. I'm going to buy it. Or Boeing down 20 points in a second. I'm going to buy it. Those are the real buyers, which are the mutual funds and the value players. They know the value in a company. So these algorithmic high-frequency trading programs, what we call algo HFT, have gone wild. Personally speaking, it pisses the crap out of me because it makes our lives miserable. It makes our great Americans out there, their 401ks blown up, not blown up, but down 5, 10, 15% in 2 days. Mom and pop are not Clueless 8 trading members. They all should be. They don't understand what's going on. They're calling up their mutual funds, which they did at 3:15 p.m. on Thursday. I mean, not Thursday. On yesterday. Panic. Sell my growth fund. This is crazy. This is just like 2008, 2009. I just want to go into cash and sit it out. That's a normal reaction of a human being, and you can't blame them. And that's what somebody texted me last night and said, you know what? They couldn't even get through to TD Ameritrade. Imagine getting through to a mutual fund like Fidelity, Putnam Investment, Vanguard, Oppenheimer, all the big names. There's so many of them. The phone lines were jammed. They had a slew of orders that they had to execute because when a customer calls in and says, sell my growth fund, blah, 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 they don't own individual stocks. Mutual funds just hold baskets of stock. And I started my my career at Putnam Investments in Boston. So I know how the game works. If you can do it right away, you got to put that money aside and do it at the following morning. But you're obligated by law to do it that day before 4 p.m. That's why the market collapsed 700 points and then ended at the devil's number 666 or 665.56 to be exact on Thursday, because those orders had to go through. Guys, this is the reality of what happens. There is nothing fundamental about it. It's all technical. And the algos in the meantime are just going haywire. It's like those crazy videos that guy used to make, Girls Gone Wild, right? So, well, these are algos gone wild in a bad way. So I am very wary about the market, to be honest with you. There is no, you hear on TV saying, we're not, what do you call it? What's the term that I'm looking for? They said, we're not in the clear yet, or we're not out of the woods yet. Have we ever been out of the woods? This whole market is the forest and the woods. Even when the markets were going higher, a lot of our members and stuff were so scared stiff. Now the markets are going lower. Now they're really terrified. We are never out of the woods. That's why we deal with tactical charts. So we know where we can go, what the ranges are, where we'll hit a top, where we'll hit a range top, where we're going to pull back, how far we can pull back, and we try to determine that. So on that note, let's hit the charts. That's really what's going on out there. We got a bunch of stuff going on. This government shutdown thing is very serious. It has to be done. There was some very positive news that's coming out of Washington, that they do have a 2-year spending bill in. They have the votes for it and stuff. That's great news. That's great news. But boy, if they don't get that through, it's going to be another calamity. We'll revisit the lows. I'm telling you right now. So be very careful. Be very, very careful. There is nothing. We are never out of the woods. I never treat, even in the best of days, I don't, I'm always very wary. Only the paranoid survive. Andy Grove, the founder of Intel, said that in the 1960s when he founded Intel. If you're going to be a trader, if you're going to be a sharp investor, if you're going to make real money, then you have to be always vigilant. You can never be complacent. Doesn't mean you have to be scared all the time. But let that fear that goes through you, which goes through me too. Believe me, I was scared the last 2 days. I'm still scared. Makes me very wary, aware. And that's the reason I put so many powerful charts out there, so you guys know what you're walking into. It's thin ice. It doesn't mean anything's wrong with the U.S. economy. Is doing fantastic. The Trump administration has done a phenomenal job. And I think they'll keep on doing a phenomenal job to help the U.S. economy and the country. But we have to be careful. All right. So let's go through a bunch of charts to walk you guys through it. And I posted these before. So this is your short-term tactical chart. This is where we were on the E-minis and when the S&P was at what, 2,900. Seems like so long ago, right? The year high was 2,872. Well, intraday, I think we went close to 2,900. So anyway, so here the chart is very easy to read. That was the band we were traveling in. This is where we broke. This is where we started the fast selling. That was on Friday. On Friday at 9 a.m. We pulled down till about overall, we pulled back on Friday. We tried to rise on Sunday and Monday, and then Monday at 10 o'clock we gave in. Right? We gave in. That was the day, yesterday, for example, at 12 noon when I said, let's go in there, buy the 27.35 puts, which was around $4.20, and the frigging went to 90. So I did my job. You know what I'm saying? I mean, that's out of control. And I've said it before, and I won't lie. I didn't hold it till 90. I sold a bunch of them, pretty much all of them at around 17, 18 plus, and then had a little bit left and let it ride, and that was gone like at 60 or whatever. That's huge. I didn't expect this type of thing. So this was your big drop on Friday. This is where we are right now. So this is a very clean chart. You have the channel here. The upper end of the channel is around 2750. And after hours in the middle of the night, at around 11 p.m., around there, futures actually hit 2,529. Now I'll show you another chart which I've already posted earlier, and some of you cared to look, and it's very important that you guys look at this stuff. And I'm kind of walking you guys through it, what I've already posted. We actually hit almost a 50-week moving average. Unheard of in one day. The greatest thing is about that is that we were going for a 10% correction type of scenario. We already got it. And you normally get these once a year. So we already got one. Don't expect a 20% correction unless something really dramatic is going on that is truly not just a black swan, but a swan with fangs. Okay? We get normally a 10% type of correction once, maybe twice a year. We're getting one in February. So the opportunist will look at it and say, wow, we got cheap real fast. We gave back all of 2018 gains. So the opportunist and the optimist will say, you know what, this is great. I missed that big 2018 rally. I get a second chance to get in there. The pessimist will say, oh boy, we're getting a 10% correction here. We'll go down another 20% tomorrow. Ain't going to happen like that because it's never happened like that. Even if we go down in that 10%, it'll only happen after we have a sizable bounce. That's the way I'm looking at it. After we get that reflex bounce, then we shall see whether the market will do a double retest of that 2,500 number again. Very possible. You get a government shutdown, believe me, we're going to get that within an hour. So the futures down 15, 20, 30, 40 in a way is making me immune to things. Before, if futures were down like 15 and I'm long SPX calls, I'm like, oh boy, not feeling good, this and that, right? But now futures down less than 20, I'm happy. I'm happy. Futures down 5. Like, yeah, so what? It's a blip. That's what the mind does. When you're in war, you become battle hardened as those shrapnels hit you right, left, and center. The first shrapnel, when I don't know if you have friends who have been in real combat. I have. And when the first shrapnel hit them on the elbow or the knee, they're like, oh, I'm dead. After like 2 weeks in the battlefield, and this is urban warfare. Okay? And this is reality. What they told me over beers. They were just like, who cares? They got one like which almost sliced off the ear, like, oh, bomb, don't care. Well, that's the market right now. guys. You gotta get battle hardened. All right. The future's down less than 10. Be happy. Future's up 10. Be happy. Future's up 20. Sell the crap out of whatever you have. Like I say, everything is on a predetermined level. Okay, that's the way it is. So let's look at what we're looking at. So first of all, the upper end of this channel, clearly defined, is a complete pattern, first pattern completion, which is somewhere in that 2750 maximum on the 2775, 2778 level. Once you get towards these levels, don't be sitting around saying, oh, boo, we're going to go all the way to the highs. No, no, no. Yes, it can happen. But the first immediate action as a trader you got to do, you got to sell all your fast-moving profits. I'm not talking about sitting on the biotechs that we're waiting for buyouts and the long-term swing trades and stuff like that. I'm talking about your trading stocks, which are different kinds, right? There are certain, there are tech trading stocks primarily, then there's the Boeing type of trading stocks, or the LMT or the Caterpillar, which are basically the industrial trading stocks. Those are the ones I'm talking about. Those are the trading stocks, which are a proxy for the markets. I'm not talking about sitting on blue or well, Juno's gone now, taken out, buyout, I mean. Or CRISPR, or EDIT, gene therapy, or Sarepta, and things like that. Those, you just keep on rolling the options till one day it's going to happen, unless the chart completely breaks. All right. So remember, the three types of trade. I'm just doing a little segue. The three types of stocks that we trade, aside from the SPX and the RUTs, which are the indices that we trade. So the three types, right? So get this through your head, and you got to think like a professional trader. You trade the the techs, which are the FANGs, right? Which will move on the day the Nasdaq's moving hard. So you got the FANGs, and in the FANGs you have you have stuff like Overstock, which was up a good solid $6 today. I didn't push Overstock today, but Overstock is a stock that we trade a lot. So, and then you got the Squares of the world, and things like that. So the FANGs, the Overstocks, the Squares, whether it be Qualcomm, you name it. So that type of stuff. The secondary tech stocks. Then you got then we have our biotechs. Now the biotechs, generally speaking, some days you can trade it on a daily basis, but most of the times, at least the basket that we own, let me call it the buyout basket. We have a bunch of calls in that, maybe a little common, and we're sitting around in it. And they kind of move around, they move up. You can always take a little profit here and there. You can trim things. That's trade management. That's up to you, what you want to do with it. I call it the buyout basket. Then you can trade, these days it's very difficult, but then you can trade things like, I remember we used to trade Regeneron a lot. But now it's just, it doesn't even move $14. It used to move like $20, $30. Remember that? So you have the Biogen. You can trade this stuff. The Biogen, the Illumina. I'm going to put Regeneron, which was up 6 points. You can trade a little bit. I don't know how much you make money on the options because it really hasn't really moved in a big way. But today was nice, $2.66. Hats off to Golfi, Celgene, things like that. So you can play that. But generally speaking, I'm sitting on somebody called B came and left. I'm not sure who it is. So that's one category of stock. The third category is basically the indices that we trade. Oh, I'm sorry, the industrials. One second. The industrials. So I'm going to put it here. The industrials that we trade, which include, and this should, set out in your head like the category of things, the way you, as a trader, you should be approaching things. We have a miscellaneous category, which I'm going to put first, which are the alters. We things like well, in by the way, under the text, I forgot to mention we trade Roku. I'm going to make a whole list of that. I'm going to put it out on the website because those are the type of things that we do, that we trade on a daily basis or in a swing basis. So on a miscellaneous side, we have Alta, we have Chipotle. Thank God we didn't do earnings and stuff on Chipotle, right? Stock was like hugely up, now down 12. It's probably going to run up again. Then we have things like Weight Watchers, which has been a great swing trade. We have AutoZone. We have Advanced Auto Parts, Orly, whole bunch of names. Then we have the industrial ones. The biggest names we should literally be trading every day is BA, Boeing, Lockheed Martin, Caterpillar. And without stretching too hard, it's good to concentrate on a few that we get to know. Things like URI, things like that. And then we have miscellaneous names on fast movers that we buy, which are, which you guys, trying to think here. A lot of the like blockchain names, we go in there and it's up like 30, 40%. We'll take profits, or we don't necessarily sit on them too long because you got to take the profits as it goes. The blockchain names, I'm trying to think more names here. Well, I'll leave it at that. Fast movers that we get into. For example, one of the fast movers that moved really, really hard today was NETE. That was up like 20%. NetEase, because supposedly they are getting contracted by Google Wallet to run their operations and things like that. Then we have like small, like NXTD. That was up like 17%. So those are things separately. So these are the main categories that we trade. And the easiest ones, one second, the easiest ones, not easy, there's nothing easy about the business, but the ones that we can see the flow where the tactical charts are delivered and stuff are obviously on the tech side, on the techs, and these ones. These are the two that you can consistently trade every day, and it makes them decent money depending on which way they're going. Go ahead with your question. Oh.
Yeah, and also the Chinese stocks, right?
Yeah, yes, of course. My apologies. Thank you for reminding me. The China stocks that we trade, the Alibabas, the JD, the NetEase, things like that. Alibaba being the biggest name that we trade very, very often. So that's really the whole category about thing. Now I also realize that it is not possible to trade all these different categories at the same time. That's obvious. It doesn't matter how big your trading account is, and the more you're spread out, yeah, it's good. Diversification is good. But when the market has its swing down, so let's say, for example, you got, let's say you have a reasonably large account, you have a couple of $1,000 in each of the options on each. When the market takes a nice little tactical pullback, well, guess what happens? You'll be down like 15K in like an hour. Of course, you'll swing back up nicely as this happens, but it's not a good feeling. So that's trade management. That's for you to decide what you need to do. But just as a general suggestion, if you stick on a strong day, if you stick to an industrial like Boeing or Caterpillar or Lockheed Martin, at least you're not going to get whipsawed like nuts. On the tech side, expect more volatility, just the way it is. So I don't want to get into the trade management side too much because I want to cover the charts to it. But I'm just explaining. So at this point in time, pattern completion will be around the 2750. And one second, I'm going to put a number here. There, 2763. right? So if we do the math here, we're at 26.89, 27.63. So we're talking a nice move up there. Now, we could possibly get that in the next 2 days. So don't be like, sitting around saying, oh, he's going to go higher. You want to take some as long as you place yourself somewhere in this zone, even not necessarily at the bottom this morning, but even here, because this is a nice cup and handle. This is a bull flag actually right there, moving sideways. If it breaks out, it's going to be very quick. So if we run up from 26.89 to 27.63, which would be the pattern completion, that's 74 handles on the E-minis. 74 handles is roughly 444 points on the Dow right here. So it's 400, I'm going to say 450 points. And I think that's very likely because we were up 567. So if we are up another 450, let's do the math. 7, 11, we'll be up 1,017 points. Well, guess what? That's a 50% retracement overall, given the fact that the Dow has lost almost 2,000 points plus, right? So if we gain back, we lost 2,000 points. If we gain back 1,017 points, so let's call it 1,000, that's okay. That's very doable. And that only brings us up here. Technical analysis, this is an hourly chart. This magenta line here is your 150 simple moving average. 150, this is actually not the day, so 150 hour simple moving average. So that's a major point. So that's the way you gotta trade this market. You gotta trade the ranges and you gotta trade the patterns that I'm showing. Because all I do, I'm no genius, but I'm a good spotter of pattern. All I'm doing is I'm looking, each of these lines are drawn at points where the market completely fell apart or where the market basically started to, hit that tactical low and started to run. So these are supply points, these are demand points. Here's your supply point where they started selling hard, and that's right, slightly above 2,800. There's a major supply point where the dam broke, and that's where the market wants to go, in my opinion. And it's setting up like that because that's pretty much what it is right now. It's like a cup and handle. Let's move on to the next chart. The next chart would be
Hey, Clue. Well, one sec. It seems like if we get a strong market, you don't have any of those averages to fight against it. So there shouldn't be much, supply in between there.
We don't have what?
You shouldn't have much supply in there, right? The 150 is the only thing that's stopping it on that last chart you were showing.
No, not true. What do you think this big bad ugly red line is? This ugly red line is 2813. That's right above that.
No. What I'm saying to you, your pattern completion doesn't seem like there's much headway between now and then.
Oh, okay. Well, there is. There is your 20, the 20 SMA. Then you have the 34 SMA. Remember, these are all pointing down. So for a trader, they got to keep that in mind. These are all pointing down because they all crossed over down at the, when we broke the dam here. So each of these things, just keep in mind, I agree with what you're saying, but each of these lines will act as immediate resistances as we move towards this zone here, which is basically the 50 and the 150. So each of these lines will act as a thing. But given the stows, given the huge volume, chances are we're going to blow through these rather quickly. But before we get there, you're going to find some formidable resistance right here at 2760. So if you're trading the market, whatever, I don't know what stock you're trading, and we showed the category of stocks that we trade, but the high momentum stocks, they will all hit these levels and immediately sell. Just the way this morning, I said it's going to hit the pivot, and right after that, within 15 minutes, the market was down 150 points. So that's just the way the machines work. So let's move on, not spend too much time on just one chart. So the next one would be, let's take a look at this. And these are more powerful charts here, okay? So you have, for example, the NASDAQ, which incorporates both the incorporates both the techs and the biotechs. We basically fell apart here. I mean, thank God for that stick save, right? Because otherwise we'd be looking at 61.94 down here, which means Apple would be at $150. All right. So this was big. That's a very powerful bullish reversal. It came as low as it came. Well, that's the NDX, but let's look at the NQ. Hold on. That's the futures because it shows us where it actually went. That's a much better chart. So you got in the middle of the night, we were down all the way down here, approaching. Remember, I said this many times, and I'll say it again. If a market benchmark breaks its 150-day SMA, I'm telling you, it's a far more powerful thing than the 200 that everyone looks at, because nobody really looks at the 150 other than real pros. The 150 SMA, simple moving average, or EMA, exponential moving average, whichever one that you use, you break that, there's something really, really, really bad happening. And the fact that it approached that was really scary. And the same thing happened with S&P 500. Okay, guys? So these are very dangerous things here, because what happened yesterday was so enormous that, remember one thing, it doesn't matter how much we know, how educated I am and try to understand this. Sometimes we just don't know what exactly is going on, whether there's a massive crack on the high yield market or something's going really wrong with the Chinese, which they have a real problem, which they try to fix, but still, it's still there with their shadow banking market. If something blows, oh boy, there's nothing we can do. It always happens in the middle of the night. So anyway, so we approached that and we got back in the channel. So that channel right now is telling us that we're going to get up towards, it looks really powerful. It looks very powerful, and we haven't seen these type of reversals off the lower channel, which I said we would get to. I just didn't expect we'd get to there in 24 hours. And I mentioned that before. So we are now back into it. Does it mean that we're going to go all the way up to 7,000 on the NASDAQ futures, which means Apple goes back to 166, 170, Google goes back to like almost 1,200, or at least 1180. Priceline gets back to 1,900. Well, that seems like it's already happening. Amazon gets to 1,500. So those type of things, I don't know. All I know is that it's a very powerful hammer reversal, and that's very bullish. This is good. This is very good. It's turning, and this is on the daily charts, and this is very good too. The fact that we got this deep oversold. Remember, the reading, if you look on the right-hand side, was minus 367, and I mentioned it a few times. You get minus 367 on the McClellan oscillator. It is huge. And like I said, Tom McClellan mentioned the same thing that I was showing you guys the day before, and it was great to see him validate my point, because he is the inventor. His father was the inventor of the McClellan oscillator, which is used by every major institution in the U.S. on the technical analysis basis, and that Kramer was trying to explain in simple terms today as if it was like rocket science. It's really simple. So bottom line is that the McClellan oscillator, when it gets to that level, you literally have to buy hands down. Baidu's Baidu. We take a look at it. I know you're in love with Baidu, but I think. Oh, you mentioned Baidu, like one of the China stocks that we trade. Yes. Sorry about that, Trent. So all right. So this is where we are right now. Now let's take a look at the SPX, and this has been. This is a very critical chart. I think I showed that. And I will show it again. Hold on. Perfect. So this is from December 16. This is from right before the elections. And this is your acceleration channel. Let me make this a little bit thicker so everyone can see it. There you go. And that's the Trump rally, right? That's what we call the Trump rally. So bottom line is that the Trump rally was, that's your acceleration phase. This is the broad channel. We broke out of it on November. of last year on the SPX, and then we broke out of it again in a big way in January, right? So we went berserk on the top end, almost 2,900. When you look back in hindsight, that was like really stretched. And I kept on saying, we're like, we don't have that much room to go. That's wave 5. If you remember wave 5, I kept on talking about. Well, the wave 5 got, decimated. I mean, wave 5 happened. And then everybody got too excited. And this is what happens. Except it happened in a big way and real fast, which is the good news. Because if this 2,000 point drop, imagine, was stretched out over 2 weeks, it's like water torture. It's like waterboarding. Except this just happened. Boom. It didn't feel good. It was just like, oh my God, what's going on? But it's the best thing that happened, in my opinion. It washed out so much froth in 24 hours or 36 hours or 48 hours, whatever you want to call it, since last Friday. So it did that, and now this is where we are. Now, this is a weekly chart. So on the weekly chart, if you want to look at it, we have a very sharp reversal hammer, but it's still red. I'd like to see it green, but it's only been 1 day. But this is certainly, it bounced off the 34-week moving average, which is right here. You can see the number here, 25.75, and it actually went. It came as low as 25. Well, it actually went lower, but the SPX doesn't trade after hours. The E-minis do. We actually touched this and went lower than this. We actually came close to. We came to 25.29 or something like that on the S&P 500 after hours, converted on the E-minis. Does everyone understand that? We actually came down here last night when Nikkei was down 1,100 points. The futures were down 1,100 points. We actually came down here. That's good enough for a really sharp, ugly correction for now. So bottom line is that we did all that stuff, all happened overnight, good stuff. So at this point, we can basically project that we can move up to about 27.45. Like I've explained before on my previous thing, another 400 points or so before we hit another roadblock. Okay, or if the tax, the infrastructure thing passes well, it makes sense, the market accepts it as a good thing, which they know it's a good thing, but the question is, it's not just a $1.5 trillion infrastructure, who's going to pay for it, right? So you got to figure out the revenue recognition, like where's the money coming from? Because we aren't going to be printing money like crazy and putting ourselves more in debt, right? So you just can't say, oh, I'm going to do a $2 trillion infrastructure plan. It has to be a public-private partnership. Well, don't want to get into it right now, but that's really what would make the most sense. Wall Street raises a significant amount of bonds, like a USA bonds and stuff like that, infrastructure bonds. The government puts in half the money. Let's go to work. The government says, I'm going to pay $1.5 trillion. That means our deficit just went up by $1.5 trillion. The market's going to croak. Trust me. All right. That's just the way it works. So we don't want to be in like 100 or more debt that we're in right now and keep on printing money. So anyway, so that's like sort of the next hurdle. So this is what we're looking at, another 400 points or so, and we see what happens. Now here's the negative. The negative is on the weekly, we broke on the full stochastics. So this is still pointing down. Not a good thing. That means it's telling us that after we get that 400-500 more point bounce, we're most probably going to come and retest the lows. Just giving you a little heads up here. That's pretty much what it's telling us. Unless this turns, generally we get substantial reversals off much lower levels down here, or when we are below deep oversold here on the weekly, which was the case back on October of 2016, right before the elections. And that was the Trump rally where it started, right there, right there. Okay? So what this is telling us, and I don't want to keep going on and on, is that we still have room to move down before we turn up. I'd like to see on a weekly basis for this to move, curl higher. Now that can happen. The only way that's going to happen is that we get a big move up to the upper channel and then another candle, green candle, that takes us above and changes, sort of a trend change. So now it's like this, but we need to move here. Don't necessarily need to go to the highs, but we need to stay above this broad white channel, which basically means we need to stay above 2743 on the S&P 500. That's the way a professional looks at. No emotions, nothing, just pure tactical numbers. So that will turn this number higher, and we need to have overall not every single day up, but remember the follow-through day? From the day that you collapse, the fourth day has to be a higher day. That basically is a follow-through day, and I'll be showing that tomorrow. So basically today is what? Today's the 6th, so 7th, 8th, 9th. So by next Monday, the 12th, has to be a higher day, because the crash happened yesterday, right? The 5th, today is Tuesday. So 1, 2, 3, 4. By Friday or Monday, but most likely Friday, we need to have an up day. Because if we have a really down day on Friday, that means we did not have a follow-through day. A follow-through day, and I'm going to put this down, and I've shown this before, and it's something that was devised by William O'Neill, Investor Business Daily. The follow-through day is the fourth day after the big decline, right? Is day 4. And many of you remember I've shown follow-through days before. So day 4 is Friday. Or if you push it, if you say, oh, today we were down big in the morning, well, worst case scenario, Monday. If Friday and Monday are not up days, that means we're coming in for another quick, sharp pullback. So that's a picture of what's going on with that. But if you look at the daily is very oversold. You don't see that too often. The last time it was this oversold was back in August. I mentioned that on my tweets, August of 2017, and look what happened. So again, 2755, 27, most we can get to on a very powerful surge is around 2800, which would be phenomenal. That's 100 points from here, right? So that's about 600 points from here. And this is starting to look good, but it still needs to turn. It's still in that zone where it hasn't given that complete green light yet, even though the market never gives us a big green light. Whichever the case, on the daily, the 50 moving average is at 2720. We're not even there yet. You guys see that? Now, this is all very relevant to our daily trading, because any of these movements, minor movements on the S&P and the E-minis, rocks the boat on the profit side in what we're doing with individual stocks. Does everyone understand that part? Yes?
Yep.
Okay, sounds good. So that's that doesn't mean every individual stock. Some individual stocks don't even care what the S&P is doing. They're moving on their own volition. So that's fine. I'm talking just in general. So we need to recapture back the 50-day moving average. That's the first thing on the to-do list tomorrow. We need to get over 2718. Some safe measure, we need to be at 2720, and we're at 2795. So that means another 25 points on the S&P. That means we need to go up another 150 points. Pronto. No questions asked. Because when we broke this 50-day, it was just like, boom. And then, of course, we know the reasons why that happened. So we need to get back up there. And what would be really bullish, as you know by now, is a bullish engulfing candle that takes over and goes over the body of this very ugly flash crash candle. So it has to be one over 27.75. That's when the hardcore shorts are like, oh Lord, gotta get out of Dodge. Okay? Otherwise, they're gonna keep on shorting the market. Believe me when I tell you. Believe me when they tell you. Some of these hedge funds are committed shorters. The George Soros of the world are committed shorters. They keep on shorting. And they keep on keeping the pressure on the market. And every single slice of negative news coming out or semi-negative news coming out, they're going to hit the bid. Boom, boom, boom. Okay? And keep us down. So we need to basically get over the 50-day moving average at 27.20. Just, keep a mental note of this stuff. Not exactly 27.19. Like I say 27.20. We got to get over the 34-day moving average at 27.56, 27.57. Then we can breathe and say, okay, we can hold it swing for like a couple of days or stuff like that. Everyone get that technical perspective? Yes?
Yes.
Okay.
Yes.
Now, good. Now, in the meantime, the good news is, I always like to look, see the bright side of things. It's a fault of mine. And why shouldn't we, right? We're healthy. We can talk, we can hear. My wife was watching some show, The Good Doctor or something. I guess it's the same script or screenwriter as House. Anyone watch House, the medical show? Anyone seen that? No?
Yes.
There you go. So we know the brilliant show, right? So the same writer, I think he's got this new show out called The Good Doctor. So I just saw it for the first time. I was lying there taking a breather. I'm like exhausted. Like, oh my God, what's going on with the markets? I'm watching this. And there was this showing this guy, just a random guy, and it's a pretty cool show. And he's diagnosed with this colon stuff, and he's got 2 kids. And for a minute, it just struck me because I was feeling like crap yesterday, right? And thinking to myself that look at what's going on. We're healthy. We got our limbs working and stuff. So thank God every minute of the day. Forget about every day. Every minute of the day for what He's given us. Be grateful and just look at the bright side of things. So that's what I'm trying to do. Okay. So bottom line is, and that thing hit me. Sorry about sharing that with you, but it really hit me. Like you watch some of these shows and they're showing these great people, like all of a sudden you're just diagnosed with something, and it happens to a lot of us, right? And a lot of people that we know, and it just hits you. So let's look at the bright side of things. The bright side of thing is we just had a complete Armageddon type of crash in the past 1, 2, 3, 4, 5, 6 days. If you want to count the whole thing, and the 7th day. On the 7th day, the phoenix rose from the ashes, right? So the bottom line is that despite all that, and you know what I'm going to say, the major moving averages, the 20-day, the 34, the 50, they didn't buckle. They didn't buckle. Like they didn't go like, kamikaze dive like that. They didn't even buckle. Of course, the 5-day did, because the 5-day moving average, that's always denoted in yellow, will follow what's happening with the market. So we need to basically go over the 5-day moving average in order to what we call, if this is the 5-day moving average and we go over it, that's a short-term trend change. So we don't have a trend change yet, guys. All right? We only get a trend change once this 5-day moving average turns around, and that will happen over roughly 5 days from now, which brings us into Monday, right? There you go. So bottom line is that what I noticed is, on the bright side of things, that the 20-day moving average started to ease back a little bit, but the 34 and the 50, they're acting like nothing happened. And the media is making it sound like, and we felt it too, we felt the earth, tremble. So there you go. All right, so that's the positive part. Let's take a quick look at the RUT, which I like a lot, and I think got smashed the most. And the RUT is a more defined chart. It's very mechanical, very positive. It rose from minus 357, clean move up. McLaren oscillator turning on the daily. This is starting to turn. Early signs of a turn. And on the charts itself, it's it's very readable. So here we are. That was a low on last December. It was a climactic low, and then a big bullish candle turn. Well, we are back in that range again. That range was 1507. I'm sorry, not 1507. That range was 1505, give or take. And we are basically above that. That's a very powerful candle. It tested. This is what excites me. And this is where I think a lot of money can be made. And you guys know that I've been very right on the swing trades on the RUT, as long as we have the patience and the discipline to hold it. Doesn't matter if you buy one call or not, you just got to hold it. And that hold needs to be at least a week to 10 days. Okay. So given the fact that it retested the 150-day moving average, and listen carefully, it slipped well below that, hit the breakout level. Remember, this blue line is the breakout level. The RUT, or the US small cap growth, broke out on September 26, 2017. Right there. Right there. Okay. A lot of money can be made on the Russell 2000, guys. So do what you need to do. You can either buy the RWM or you can buy the RUT. So it broke out like a monster. We almost came back and retested that breakout. I always say that in the case of a massive downturn, the breakout level has to hold. That means the real players are not letting it go. If it breaks this, see you later. We're going to come down here. And that means like real move down. That means no infrastructure plan, nobody believes that they're going to do anything for the U.S. small cap growth companies and blah blah blah. Bottom line is, because remember, Russell 2000 is what I call the Made in USA index, right? So this is your Make America Great index. So for you, from a business standpoint, so the bottom line is, it tested that in November. It almost tested it last night. It actually did test it last night. Remember, this is not the futures. This is actual index. So it actually went below that. And then we had a massive reversal over the 150 moving average. That's a very positive sign. The buyers are in. So what does buyers are in mean? It means that we have the next level that we're going to hit, which is right here. Just put that up here. 1534, and the Russell 2000 moves in increments of roughly 10 to 20 points. For example, today it was up 20 points. It ended the day up 16 points. So you can always buy. The good thing about it is you don't have to buy in the money. You can always buy 10 plus points out of the money, because that's how it's going to move, depending on the directional flow. All right. So even if it's more expensive than buying an IWM call, which you have to buy quite a few in order to make some decent money, you can buy one or two of these babies and just let them be. Just leave it in there. So they cost anywhere from $3 to $6, $2 to $5, depending on whether you're buying out of the money or whether you're buying in the money, what your strikes are. Feb 16th is the best. Feb 9th is good because we are in this, acceleration move here. Whichever the case, the next move is at 1534. Very defined levels here, right there, because that was the last major low. Next major low. Right above that is the 50, which is 1551, 1566. There's a lot of room to move here, guys. And if they do present the infrastructure bill as they said they might, or the rumors are that it'll be released by Monday, that'd be fantastic for the Russell 2000. And don't forget, Monday is also the follow-through day, right? See how everything falls into place? So bottom line is, this has to be this is certainly good. It fell the most. We have traded these things very well. One of the mistakes I've done sometimes, and I'm the first one to say, is that I always pinpoint the exact entry and I take staggered profits, but I seldom hold it all the way to the pattern completion. And even though I have a little bit left, I'd like to hold these things once I see a turn for 2-3 weeks and see those things basically go from that 4-5 level to 46 and 50, which is like unbelievable. I mean, it just feels great, right? Instead of taking staggered profits along the way. But the markets are volatile. Sometimes we react and say, oh, I'll take the profit, I'll re-enter. It's up to you. Whichever the case, keep an eye on the Russell 2000. It's looking really, really good. And, a lot of money to be made. The same thing with IWM. Right there. There's your IWM. 140 to 149. Not bad for 1 day's work. And this is from 9 o'clock last night, after hours. And best, and then you got these 3 big trend lines looming ahead. There's one downtrend line here at 155. So even if you get 6 points, which would be fantastic, or even if you get 153, House and a bunch of you guys know that's a lot of money. So it's right there. This is a Fibonacci retracement chart. 50% Fibonacci retracement is 150.73. Generally hits a little bit of resistance there, but it looks like the way things are going, it's probably going to go hit the 61.8, which is at 153. So this is a great trading vehicle too. What was the other thing that I want to show you guys? Okay. These charts are purely for traders who are looking to manage their trades better during the day. I'm not talking about it. Look, I don't trade for every 5 minutes, all right? And even though we do day trades at times, or we at least take down profits and things like that, I'm not a really, really active day trader, all right? Biggest money is made on the swing trades. But if it's reaching our destination prior to that during the day, I'm not going to sit there and say, oh, it's a swing trade, I'm going to hold it for 2 days, when it's already reached where I think it's going to go. So you can clearly see what this chart is doing. It is hitting the first roadblock. That's why I have the arrow here. And that's why futures are down about 7 points right now. Not a big deal. And you know by now what to read. It can come all the way down here to the lower end of the channel. No panic, which we don't want it to do, because if it hits 26.46, it's at 26.88. That's a lot, right? Because now things are really crazy, because that's 40 points. So that means the market will be down 200 points. I don't want to see that happen right off the bat. So I would say I will draw this. There you go, and that is a bull flag, except it's a sideways consolidation. Sideways consolidation, and the range on that is 26.79. You guys have to start thinking like this, because that's how you manage your trades better, and you don't get freaked out by the markets. We all get freaked out by the markets when things like what happened over the last couple of days, but these things keep you in balance. So here's 26.79. Here's the upper end of the channel, 26.98. That's 20 points. That's $100 points right there, right there. So just got breaking news. Steve Wynn is out as CEO of Wynn Resorts. Wow. Wynn should fly now. That means that's pretty big news. Steve Wynn is out of Wynn. I just got that breaking news on my iPhone. So anyway, so there you go. So what we do need to see is it can chop around a little bit, so we could be like up and down 50 points. But what we do need to see is a breakout. And that generally can happen later in the day. If it happens right off the bat, you can rest assured they'll be selling right here. Remember, every one of these lines are resistances, and that's what it is. That's why I have these arrows here. And by now, you guys should know how to read it. So, if it opens up all the way here, that's it. The machines are going to come and sell the market hard. And then we take our profits, and then we have to wait to re-enter again. If it stays around here, where we are, and then starts to move, let's say by 10:30, that's the most optimal scenario, because it gives you a chance to react and make money during the day. You understand what I'm saying? You don't want a market. No, I shouldn't say don't. We'd like it. But we necessarily don't always want a market opening up 100 points and then not leaving us any room to maneuver during the day. We'd like to see the market open up flat, maybe slightly down, not too much down, and then do a massive reversal candle within the first hour. And that is that's pretty much, is the most optimal type of market. But this is good. And you know what the levels are. Follow this chart very carefully, because if you don't, you are going to lose your profits. That's almost a guarantee. No question about it. Because each of these levels that I'm showing you is going to be engaged as it has been. Okay? Aside from here when things just, fell apart. But now that we have a structure, that's the reason I didn't do the webinar last night, because things were so fluid, I wouldn't be able to show you guys a forecasted roadmap. But I'm showing it to you right now because it's defined. So that's it. Now, people who are not still getting used to these charts are unfortunately going to suffer and be lost in the type of completely, I would say 110% mechanical markets that we're going through, as you can clearly see. I don't need to prove it anymore. And now the media talks about it all the time, things I've been talking about for years. So that's one. Next thing is this, which is your S&P 500 futures on the daily. Keep in mind that these different platforms that I'm showing you, see how different it looks. Here on investing.com, very clear. You got a massive hammer reversal. It is still not above what I call sort of the clear zone, which is re-entering the channel. And that channel is re-entered roughly over 2,700. Over that, we're going to find resistance at 2748 and all that stuff. But at least we are inside the channel. We are still outside. We need to open up tomorrow or open, this is what it normally does. Just so you know what will happen tomorrow, most probably. Markets will open down a little bit. That's normal stuff. We just don't want it to open below 2650, in which case half of the gains are gone, and that's no good. So we want to open down a little bit, utilize that to add to some existing positions or add a new position, and then you want to see them move up into the channel. And that would basically take us into that 2750 level. Once we're in this zone here, the bears get really scared. Because right now, I can tell you, a lot of shorts out there, especially the professional shorts, they're still licking their chops and saying, you know what? I shorted here. So why the heck am I going to cover here? I'm sure they covered some here to take some of their lottery ticket profits. But they're still profitable because they're shorted here at the 2748 level on the E-minis, which is roughly about 2750, 2752 on the S&P 500. So they're going to hold on to their short. But once it's starting to approach that level, they're going to start covering. And when they start covering, you get that big fat green candle. Does everyone understand how the game works? And that green candle basically takes us into the upper end of this channel, which is 2795, which means 2800 on the S&P 500. And you're going to see big profit taken at that level. It's just the way it works, guys. It doesn't matter whether you're trading the S&P or not. Just whatever you're trading, you got to keep an eye on these things. And that's when these hardcore shorts who shorted here, okay? And I'm not even saying the ones who shorted here. Not everyone's that mechanical because it didn't look this clean when it was happening. It was a lot of zigzag up and down. But whatever the case, at this level, you're going to start to see big short covering. Once you enter the channel, the smart shorts are going to say, you know what? They're going to get out of Dodge. So that's what we're looking to do. We're looking to enter above 2700 or 2710 on the S&P 500, and we are very close to it. We are very close to it. I don't think the bulls are ready to give in, given the size of this candle. This is very good. And remember what happens. Once it gets overbought, we'll have to see if it's going to go sideways like this, which means the market continues its rally, or does it get overbought and immediately plunge, in which case it'll just get up here and then pull back again. So that's for me to decipher and let you guys know, but you guys should know how to read these charts. What's the one that I wanted to show you? That's your Russell 2000. Very easy to read. Levels are very defined. This is not the futures. This is actual RUT. These are the gaps, and I think that's where it's going to go. And again, it hasn't fully entered the channel yet. Remember, when I say channel, I'm talking about this. Once it enters that, that's when it's going to go to the upper end. If it gets rejected here really hard, which I don't want to see, then we're going to be doing this again, which wouldn't feel too good. Let's see. That's the one I just showed. All right. What's this? Oh, that's NVIDIA. That's one heck of a move. NVIDIA, again, the same thing. Earnings are coming up on Thursday. Upper end of the channel is 238. I'm sorry, the Bollinger, which is still pointing down. If this stock, listen, earnings are earnings, right? We know it's a crapshoot. But it looks like, given what Micron did, and Micron was up today, found out later in the day because of a pre-announcement. So if Micron's pre-announcing strong numbers, then that's great for NVIDIA because it's right up, in the same sector. Graphics chips, memory chips and stuff like that, same thing as Micron. So MU was up huge, and I think Golfi owns MU, so that's fantastic. The stock was up beautiful. So the thing is that Micron, if it enters this channel, the first move is towards the upper end, which is 13 points. That's a lot of money. And God help us if it enters the upper channels, in which case it's going to be seeing the 252. That's a lot of money. Now, if it goes the other way, then we are looking at a buy zone of NVIDIA at back around the 211 level. So, okay, quick questions, please, before I start wrapping up.
Hey, Clue.
Yeah.
Let's say, for instance, you were on vacation for 2 weeks.
Yeah.
You didn't listen to news.
Yeah.
Someone gave you these charts.
Yeah.
What could we learn to find out, saying that we can learn next time where we could catch something so we don't catch that huge falling knife or there's nothing?
Okay, I didn't quite understand. You're on vacation. Let me kind of get this figured out. You're on vacation. Yeah, go ahead. I'm listening.
You're on vacation. You're the genius, and you're on vacation. You come back. You didn't do anything. You look at these charts.
Yeah.
Someone tells you analyze. What could we learn? Is saying what could we have caught something before it happened that we could learn from, or it's just nothing.
The answer to that question is, you're saying if I was, let's say, away, okay, for whatever reason, for 2 weeks. So the simple thing that you're trying to ask me is, like, how would you be able to navigate these charts?
Yeah. Or yourself, if you came back, someone told you analyze it. What was something that you could have caught, and you said, "Oh, I would have saw that. I could have done something different."
Well, okay. First of all, I wouldn't be able to do anything different because everything that I explained to you tonight and to everybody else is exactly the way I'm looking at the market. Okay. Now, in the olden days, when we didn't have such machine domination and these high frequency trading, I could give with higher level of certainty or much longer term view on what could happen. But I cannot do that because I'm straight up. I'm not going to lie to anybody. I cannot do that. Like what's going to happen a month from now or 2 months from now or even 2 weeks from now, because I'm showing you the pathway where the roadblock can be and where it can go to. So that's the whole point here. So monitoring these charts are extremely critical, even if you can't do it like, let's say, 10 times a day, but at least once or twice a day is critical, because these rapid movements that are going on like this, even on the way up, is has to be respected. And the charts that I'm printing out and basically sending to all of you guys and on a real-time basis are telling you that if this happens, this will happen. So in answer to your question, there's nothing different that I would do even if I was away for 2 weeks, because because of the way things are with the market. The markets are in complete flux. And this is not the first time. The markets were in flux 6 months ago, a year ago. Even on the way up, there was no certainty. We would wake up the next morning, markets would be down 200 points before they turned around and went up 100 points. So in answer to your question, it's a different world, and you have to be vigilant. So that's the best I can say. Any other quick questions for anyone else? Nick?
Hey Frank, how are you?
I'm
Sorry,
good.
I worked late. How
Sorry
you
about
doing?
sorry about what?
No, I tuned in a little bit late. I missed most of it. I just
Oh no, that's okay because this is going to be uploaded, so you guys can hear it. Don't worry, we were so busy, understanding what's going on. We actually didn't even know you were here. I'm just kidding.
Oh.
Hold on. Hey guys, you guys didn't even welcome Nick in, and she was hoping she'd be missed. Come on, guys. All right, just kidding. So, all right. That's on a different note. A couple of quick charts I want to show, like Boeing, right? And Boeing very powerful. So this is very defined. This is your gap. These gaps do get filled. And notice how they moved the stock around like crazy. At one point, it was negative, right? After being up 6, it went negative, and then it was up. Of course, it was up 13. By the time the markets went up like 500 points, which is, by the way, very bullish. It is very bullish. And but futures are down right now 12 points. So there you go. Before I speak too fast. So anyway, so Boeing is looking at, I'm looking at Boeing around 350, and that's going to be a major resistance on that. So this is a great stock to trade on a daily basis, depending on the market. Let me show you guys quickly on Priceline this beast of a stock that has the weirdest chart I've ever seen. So the bottom line is that this big move here from 1800 to 1858 has to be respected. The last time we saw a candle of this size was here. It was here. Okay? And the stock basically at that time went from 1630 to 1750. That's 120 points. So from this level, if this thing goes 120 points, then we are looking at 1920, which is right here, which is pretty much what I'm thinking it's going to go, to the upper end of the gap. This gap here is, one second, I'm going to put the price on the right there. Okay, the stock, if it hits the upper end of this gap, is 1938. So the stock could, first gap it's going to hit is 1880. That's almost a given. All right, I hate saying that, but that's like, yeah, pretty much like another 22 points, and that's nothing on a percentage basis. But the stock was only up 1.65%. Let's face facts here. Amazon was up 3.82%. Apple was up 4%. In fact, aside from Netflix, Apple was the second largest percentage mover. Nvidia was up 7%. Gotta respect this. That's when some big money is going in. Boeing was up 4%. That's very big. Anything above 2 or 3% on big cap, $100+ stocks has to be respected. When a small cap stock goes up 10% or 11%, yeah, it's great. But when a big cap stock goes up by 3, 4, 5%, that means some big money is getting in there. Big money is getting in there. MU, Micron, that Golfi owns, was up 12%. That has to be respected. Okay, LITE that I recommended was up 20%. And I think I caught it when it was already up like 6%. But that was another 14% earlier, right? So these things have to be respected. So this baby is right now going above all this damage, and none of these lines ever got compromised. 50, 34, 150. This 150-day moving average has been moving sideways for so long, and that's exactly what the stock is right now. So a move up to 1883 and a move up to 1909 and mid-channel or upper gap at 1937 is very doable. Now, earnings are on February 27th, so that's still way off. And who knows? The stock could basically, either crater all the way down to 1600 if they missed numbers in a bad way, or 1750. That's easy. Because it was just that, 1650 is, if they miss numbers or whatever they do, I don't know, and the market doesn't like it, it's going to fall 150 points easy. Or it's going to go right up here and make a new high. So, we'll at that when we get close to, we'll figure it out. We'll do a straddle, but buy the calls and puts. You got to buy like a 1-to-1 bias, because with the case of Priceline, I have no idea which way it's going. Now, if the internals are certainly showing that it wants to go higher because it's so deep oversold, so we're good to go with that. Apple, I want to show because that is a bellwether in the market. Without Apple, the Dow doesn't move these days. Without Apple and Boeing, Apple is in a very a large trading range. That lower trading range we know is 154, and the upper trading range is 180. Well, let's not push it too much, all right? That's your wide trading range. Apple hit that gap. There's your gap. Was holding fine, and the last 700 points on the Dow, or 300-400 points from 315 yesterday afternoon, turned this, which was a nice green candle, into a bloody red candle, right? Stock opened up at 153 and moved up $10. That's huge. That's like, has to be respected. There's no question about it. We still don't have a confirmed crossover on the full stochastics, and once we get that crossover, you're going to see the stock up, back, reclaiming, or at least kissing or retesting its 50-day moving average, which is already kind of pointing down because there was so much technical damage done to it. So that's 172. That's a lot of money. $9 on Apple, let's say over a couple of days. You know what it's going to do for the market too, right? But I think that a stock like Apple very seldom loses, I repeat, very seldom loses its 50, 34, and 20-day moving average. Let's call it the 50-day moving average. And consistently stays below it. Okay? So one way or the other, it's going to wind its way up here. So if you want to do a swing trade, let's say going out into end of February, early March, whatever you want to do, you want to be looking at that 172 print. Now, if it completely goes bonkers and gives back everything that it took today, then the stock is destined for 140, 150 very easily, right? That's all technical stuff. No, emotions, nothing. I'm just telling you the way it is. But the way it looks, the way this candle was formed, which was one of the largest bullish engulfing candles I've seen. You can see that yourself. When was the last time you saw a candle this week? I haven't. These things have to be respected. A significant amount of money went in, and whoever the shorts were on Apple covered hard at this level. So this becomes a very, very solid support. So at this point, one way or the other, it's going to find its way up to 172, guys. Now, whether it takes a little twist turn like this or not, most probably it will, but it's going to get there, given what I'm seeing. So get ready for that. If you want to sit on a swing trade for a couple of weeks on this or buy all the way out to 170, you can do that, my opinion. And that's going to help the market big time too. Once it hits that, we don't know what's going to happen. It could very well have a rejection and come, it probably do this. It winds its way up here, whichever way it does it. Maybe it falls a little bit, gets there. And then if it has a rejection, it's going to give back quickly. It's going to give back 6 points. So that's a cup and handle. What it does after that remains to be seen. Either it breaks out. Isn't Apple supposed to do some sort of massive buyback and announcement and stuff in March, right? So if you look at the timeline on that, we're coming into, we're going to be getting into March. So that's when the stock basically shoots up and it's back in its former glory up towards the lower 180s. And this has extra relevance and importance because it's something that moves the market. So that's it, guys. Any other quick questions? Go get some sleep. Trent? No? Yes? Because we covered a lot of important topics. And let's take a look at the VIX. I gotta show you guys that. That's the final chapter. So I showed this on the VIX last night. This was the Greek Eurozone financial crisis, which was a serious crisis. That was unraveling the basis of the euro, the currency, as well as major issues with the largest German banks who lent to the Greek banks, Greek government who couldn't pay it back. That was a serious crisis. We have no financial crisis. We have the 10-year Treasury yields, which actually went down, and the VIX frigging hit 50. Now you tell me logically if that makes sense. All right? So this gives more power to the bulls who are basically making a very strong case is show me a real financial crisis, because VIX cannot in any way or form hit close to 50 on no credit crisis whatsoever and no gangbuster move on the 10-year government bond yield. So the bottom line is, trend test, can we short volatility today at 30? Well, I wouldn't go around shorting the VIX because it's the VIX. Okay? You can. But the VIX is a derivative. So it moves like a derivative on crack. I don't know how the crack guy moves, but it's on bath salt. Okay? How about that? It'll bite your head off. So I wouldn't be going around shorting the VIX. So bottom line is that I would look for other ways to, if I need to short the market and stuff. I wouldn't be shorting the VIX. I just can't do that because this thing can just snap around and just kill you. Okay, one minor thing, for 10 minutes the VIX can spike, and everyone's so fixated on the VIX right now, can spike 6 points, 7 points. Then what are you going to do? So bottom line is, it's still a green candle. This is the weekly. It is still showing signs of strength, believe it or not. If you look at the stochastics, look at that. On the weekly, it's not fully overbought. So that means there are still troubles ahead. All right, just letting you guys know. Because once it gets to a 74 or 80, that's when it's extreme overbought. It's not there. It's still climbing higher. So the VIX very easily can do this intraday. Okay, can easily move back to 37, pull back a little bit, spike up more, test 40 again because it's a round number, then fall. So it can do all kinds of stuff. But I'm just showing you the levels where you can see this is the zone that the markets fear most. Okay? And it got out of that zone. It came straight back down. Now that's a major reversal hammer. It's still green. So it means it's not, What would be more convincing is if it closes below this previous high, which is 27. If it closes below 26, then you can dampen it down. But in my opinion, given the nervousness in the market, and you might have heard it in other media outlets, the VIX will remain elevated. The VIX ain't going back to 10, guys, because there has been a injection of volatility in the market, which is going to keep the VIX in a range of, in my opinion, between 20 and 30. 20 and 30. The VIX is now. Remember, the VIX was trading in a range of, like, we would buy VIX calls and the markets would be down 100 points. We'd barely be up 20%. Remember that? Like, what the hell? I'd buy like a whole bunch of them and they would be up like 30 cents. Or maybe we'd get a double if we are lucky. From 40 cents to 80 cents. Those days are gone. So now the VIX will move between a range of 20 to 25, something like that, and remain elevated because there has been a element of risk and fear that has been injected in the market from what happened over the last couple of days. All right? So this is what the VIX is going to trade in my opinion, and not be trading in this range that it was stuck in for a bunch of months. So this is gone. This is the new VIX here, somewhere between 17.5 to 25. And any sign of any weakness in the market, like or something coming out of Washington, D.C., that didn't, meet the deadline, this and that, the VIX is going to jump fast, very fast. But so that's I just wanted to show you guys this because it's very important. On the daily, you can see here that we have a large reversal from 50. That's a red doji. It is not a reversal hammer because look at the candle, the long wicks, but the body is in the middle. What we would like to see is the VIX close below 20, or at least below 26 or 23, and I think it will. But then it's going to be very quick. It's going to get there and then boom. That means the market's going to be up 600-700 points from where we are right now, and then immediately the sellers are going to come in and the VIX is going to jump because this 5-day moving average, you see the yellow line here, right? This is still pointing up. All these are pointing up. Now, can somebody tell me if you guys know, did this happen to the markets? And I mentioned this on my webinar about 2 weeks ago. What is going on with the moving average and where the price is? This is where the VIX is right now. Okay, let's call it between 29 and 38, somewhere in there. And here are the moving average. So what do we call that when it moves too far away? Yeah, it'll revert back to the mean. We call it standard deviation. So basically, because of this massive move that we saw in the market, the standard deviation is extreme. You can see that. You don't need to measure it. It's probably 7, 8, 9 standard deviation from where the moving averages are. Anytime, and that happened to the markets too, right? And we know that. Anytime you move too far away from these moving averages, you're going to revert back to the mean, called mean reversion. So given where we are right now, the VIX had come down to 22 at one point, but the VIX basically needs to, these are rising, so they'll keep on rising. So the VIX has to come close back, not necessarily touch it, but it has to come somewhere close to this rising moving averages. It cannot sustain itself with this type of massive deviation. Remember what I always say in simple terms. The moving averages are the highways, and if the prices deviate too much, they always revert back to the mean. And if they move down too much, they're going to revert back to the mean. In the case of the S&P 500, we had a massive move higher when we kept on going higher and higher and higher. And the moving averages were all the way down here. Well, now we not only came to the moving averages, we shot well below that. So now we are going to revert back to the mean, as I showed on the SPX. All right, guys. And that's it.
Hey, one last one. So what do you think WIN's going to do tomorrow? You think it's going to dump first and then get bought up?
No, I think WIN's going to open up $4 or $5, if you ask me. But you could be right. Initial reaction could be down. I wish we could see what it's doing. Oh, you know how you can find out? I do it on my iPhone. You go to investing.com and you can go to WIN and it gives you what WIN Macau's trading at. So let's see here. I'm doing that on my phone here. My gut feeling tells me that once the WIN is out, the stock's probably going to fly because that means the new board is going to be open to selling parts of WIN's business or something like that. So let me see what WIN is showing. Hold on. If you go to WIN on your iPhone, investing.com, that's where I check things quickly. There's a WIN Macau Limited ADR. Okay? It's WYNMY. It trades because WIN trades WIN Macau. There we are. Nothing's trading yet, but I'll find out because Macau hasn't opened yet. That's why. Chinese markets and stuff. So yeah, that's the only way there. So my opinion is your theory could be right. It dips a little bit and then it runs, but one way or the other, I think the stock's running because it's a positive. It's an overhang that's gone. It's an overhang that's gone. That means no license issues anymore. You got it?
Yeah, but isn't it more he's a visionary and they're going to lose the vision of everything he created?
Well, I understand that part, but I think the market's already taken into account that he was in deep crap and that without him, the company would still keep on running. You understand what I'm saying? So yeah, I think I agree with you. Initially, that's why the stock went down, but then the stock stabilized. And let's take a quick look at WIN. Let's get this out, all these things out. at this point, the market's already taken into account that his days were limited. So if we look at it daily, we are basically, this is actually a good chart to look at. Thanks for bringing that out. So this is a very defined chart, and I'm going to show it to you guys. We're going to trade this tomorrow. Here you should downside 160, because at the worst possible time, the most the stock got to when we shorted it was 160, right? And then we went long. So basically, the market already taken into account that his days were limited. That I totally believe in. So bottom line is you got a range of 160 to 171. If the stock falls, it's going to fall to about 160, maybe slip a little bit more, and I think we need to be buyers on that. Okay, and then on the upper end, if it breaks above, upper end, we got a lot of room to move. The 20 is 174, so stocks got a lot of room to move, and a gap fill is 178. You see that gap right there? These are the two gaps.
Yes.
This is the lower gap, that's 171. Upper gap is 178. Could be a home run. We need to be quick on that, Just buy a couple.
Yep.
Don't have to go crazy. With all these things, just buy a couple at a time, because, because regardless of how big they move, I mean, this one, when it fell, I was dead right. I was just hitting it hard because that candle was too big not to go in hard, when we first shorted it from down up here. So that was fantastic. So that's it. The lower end of the scale is 158. Worst case scenario, if they truly believe that the company is a lost cause because Win is gone, then you're looking at 155. You want to be a big, big, big buyer at that point. But I think that the stock's going to slip maybe 2 or 3 points and then immediately start running. Or the stock is just going to gap and run. So gap and go means the stock will gap up to 167 and then run towards 171. And it's going to happen real fast. But we'll deal with that tomorrow. But good point that you brought out. So that's it. On that note, guys, thanks for listening. We covered quite a few things. At least know what happened. I was a little bit confused myself. I'll be the first one to say it, but because it was just ferocious. What I thought something was really coming off the wheels there. And one has to be careful like that. But like I said, we're never out of the woods. But at least here at Clueless A Trading, we are always in the know what's going on. So have a good evening. See you guys tomorrow. God bless you all.
Thanks, Frank.
Thank you. Bye.